Impact of Silicon Valley Bank crash on the energy sector. Silicon Valley Bank, the 16th largest bank in the US, crashed after depositors, who are mostly tech entrepreneurs and venture capital backed companies, all reached to withdraw their money this week as anxiety over the bank's situation spread. We hear of the fear of missing out, FOMO, but for the first time in after almost a decade, we're witnessing how the fear of losing out plays out. Interesting, but this is not really interesting for most tech companies, especially those who bank with the SVB and those who are involved in the energy or clean tech startup devoted to combating climate change. To understand how the situation affects the energy sector itself, we have to first understand the situation. In this video, we'll break down what actually happened to the Silicon Valley Bank, and we will relate Silicon Valley Bank relevance to the energy ecosystem. We will also consider how energy tech startups have responded so far. We'll further dissect what their responses mean rather. So then we'll examine the general impacts using their responses and the general effect of this kind of situation. We'll examine the general impact of the crisis of the crash on the energy and clean tech ecosystem. Also look at how energy companies or clean tech companies can prevent future occurrence. So what actually happened to the Silicon Valley Bank? Silicon Valley Bank had closed to $191 billion in assets and nearly double in deposits and investments. Unfortunately, it had kept a small margin of that in on-hand accounts and had deployed the rest, the bigger margin, in bonds and other investments, which were losing their value because of the falling stock market and newer and higher interest rates offered by the US Treasury and other lenders. Responding to the fear of losing their money, customers started withdrawing funds and selling stocks. As a result, some startups won't be able to take loans or paying deposits or get their money in SVB bank accounts anytime soon. They run the risk of not meeting payrolls or loan payment deadlines and so more. So did someone say I should explain this like I'm 5 years? I will do that. Imagine you have a piggy bank where you have all your allowance and keep your petty money. Now, instead of keeping all that money in your piggy bank, you decide to invest some of it in toys, hoping that their value will increase over time. Silicon Valley Bank is like a piggy bank, but on a much bigger scale. They have a lot of money from many people, and they also invest some of that money to make more. However, sometimes the investment they make can lose value, just like how the toys you invested in may not be worth as much as you thought they would be. Because of this, some people who may have put their money in the bank are worried that they might lose it, so they want to take it out. This can make the bank run out of money, like how you might run out of money if all your friends ask for their money back from the toys you invested in. This is a big problem for startups who rely on the bank to have money to pay their employees or pay back loans. They may not be able to get their money back from the bank on time, and this can cause them to have trouble meeting their own financial obligations. And this does not exclude energy startups. So, what was the Silicon Valley Bank like before the Hula Value? SVB had a dedicated clean tech practice, and this distinguished it from traditional banks. SVB became the go-to bank for clean tech entrepreneurs and businesses. In total, SVB had more than 1,550 key customers in the climate technology and sustainability sector. Just last year, the bank had vowed to commit at least $5 billion in loans, investment, and other financing to support sustainability efforts by 2027. Because of this and for many other reasons, Silicon Valley Bank was revered by many startups and energy entrepreneurs for its generous lending practices as compared to some other more traditional banks. Now, compare their $5 billion sustainability commitment to the $150 million pledged by JP Morgan's asset management company for cleantech funds. It is simply incomparable. So, ever since this crisis started over the weekend, cleantech startups have responded, and I've had picked some cleantech companies banking with SVB in order to determine how it affects the market generally. They have released statements concerning their stakes in the bank and on whether it will have significant adverse effects on their operations. Some of their statements are, however, shrouded in technical jargons that investors and other stakeholders like you and I may not understand. So I chose to go through the rigor of breaking down their statements to convey to you listeners what they really mean. The first cleantech startup would be, or cleantech company we'll examine is Sunrun. Sunrun, in their statement, stated that SVB was one of the lenders in two of its credit facilities, but said it was less than 50% of its total hedging facilities and does not anticipate any significant exposure. Sunrun has cash deposits with SVB totaling nearly $80 million, while SVB undrawn commitment in the non-recourse senior aggregation warehouse facility is about $40 million. So this is the technicalities they've written in their statement. So I'll break this down in order for you to understand. Sunrun is a company that uses money from different sources to do its business, like buying solar panels and installing them on people's homes. One of the places Sunrun keeps its money is in a bank called Silicon Valley Bank. Sunrun also borrowed some money from SVB to help it pay for things for its operations. However, Sunrun says that it only borrowed a small amount from SVB compared to all other places it borrowed money from, and it doesn't think it will be a big problem if SVB has trouble paying back the money it borrowed since it has crashed now. Now, Sunrun also has some of its own money called cash deposits in SVB. The total amount of money it has in SVB is about $80 million. Additionally, SVB promised to give Sunrun more money in the future if it needs it, but Sunrun hasn't used all that money yet. The amount of money that SVB promised to give Sunrun in the future but hasn't given yet is about $40 million. So with SVB crashing, the possibility of this payment being made or this promised money being granted to Sunrun becomes nebulous, becomes uncertain. So that's the situation with Sunrun. Let's look at the next cleantech startup company, Sunnova. Sunnova, in their statement, also view its exposure to SVB as negligible since it does not hold cash deposits or securities with the financial group. However, one of its subsidiaries is part of a credit facility where SVB serves as a lender. SVB has unfunded commitments of $15 million under the back leverage facility, which is one of 3 warehouse facilities currently entered into by Sunnova's subsidiaries, with a total commitment of $1.35 billion. Like I did with the other company, I would break this down also for you to understand. So, Sunnova is another company that does business with Silicon Valley Bank. Sunnova says that it doesn't have any of its own money called cash deposits or securities in SVB. So it doesn't think it will be a big problem if SVB has trouble paying back the money it borrowed. However, one part of Sunnova's business did borrow some money from SVB, but Sunnova says it's not a lot compared to all the money it borrowed from other places. SVB also promised to give Sunnova more money in the future if it needs it, but Sunnova hasn't used all the money yet. The amount of money that SVB promised to give Sunnova in the future but hasn't given yet is about $15 million. This money that SVB promised to give Sunnova is called an unfunded commitment. It means that SVB has promised to give Sunnova some money in the future if it needs it, but it actually hasn't given Sunnova the money yet. So this is similar to the situation with the last cleantech company we examined. So the next cleantech company now is Spruce Power. Spruce Power says it has less than $1 million of cash deposit exposure in operating accounts held with Silicon Valley Bank. Several Spruce Power subsidiaries are borrowers in non-recourse senior debt credit facilities in place with SVB as either a sole lender or a sole lender rather, or as a party to a group of lenders. While in some instances, SVB is a counterparty to interest rate instruments associated with these facilities. After initial review, the company has determined, that is Spruce Power Company has determined that such exposure represents immaterial operational and financial impact, as you can see from their statements here. So what does this really mean in detail? Spruce Power is another company that does business with Silicon Valley Bank. Spruce Power says that it only has a small amount of its own money called cash deposit in SVB, and it is less than $1 million. However, some part of Spruce Power business borrowed money from SVB, and SVB also promised to give Spruce Power more money in the future if it needs it. Sometimes when companies borrow money, they also buy something called an interest rate hedge instrument. This is like buying insurance that helps protect the company if interest rates change in a way that would make it harder for the company to pay back the money it borrowed. SVB is one of the companies that sells this interest rate hedge instrument, and in some cases, Spruce Power subsidiaries bought them from SVB. After looking into this, Spruce Power says that even though SVB is involved in some of these interest rate hedge instruments, it is not a big enough problem to really hurt the company. Spruce Power further says that the impact on the company's operations and finances will be very small, so they are not too worried about it. Yes, that's the gist from Spruce Power. Then, lastly, the gist from STEM. STEM is a company that uses artificial intelligence to help with energy solutions. They recently made a statement about Silicon Valley Bank, which is the bank they have some money with. STEM says they don't have any loans or other big financial deals with SVB, so they don't think that the problems with SVB will affect their businesses really. STEM also says that they have their money in a lot of different banks, not just SVB. So even if SVB has problems, it won't affect all of STEM's money. STEM then thinks that less than 5% of their money might be affected by SVB's problems, that is the crisis, but they are still looking into it to be sure. Overall, STEM still thinks that the problems with SVB won't hurt their business, and they'll keep an eye on the situation to make sure everything stays okay. Having considered the statements from various cleantech companies, from their responses, we can bring out some effects the crisis has had. So we'll use that to address the general impact that the SVB crash might have now. So it is expected that these companies will pretend nothing has gone wrong and the crash is negligible. So they are not disturbed, but there are real problems they won't tell you about. First is the availability of credit. The SVB crash reduces the availability of credit and other forms of financing for energy and clean tech companies banking with SVB. This can make it harder for these companies to access the capital they need to invest in new projects, expand their operations, or meet other financial obligations. Even in instances where these deposits are met, credit facilities are no longer available to companies with SVBs, and this is one area where they are important to clean tech entrepreneurs. Another impact is increased financing cost. The crash leads to increased costs for companies that are still able to access financing. If other banks and lenders are unwilling to provide financing at reasonable rates, companies may have to turn to more expensive sources of capital, which can eat into their profits and make it harder to compete. Another major but subtle impact is the loss of confidence in cleantech status by investors. In a way, this crash can lead to a lot of confidence in the clean tech sector as a whole. Investors and other stakeholders may begin to see the energy sector as riskier or less stable, which could lead to reduced investment rather and slower growth in the energy tech space. Further, this disaster has ripple effects on the broader economy. A liquidity run on a bank that supports the energy sector would also have ripple effects throughout the broader economy. This means energy and clean tech companies are often important drivers of economic growth and job creation. So a slowdown in these sectors could have negative effects such as massive layoffs, consumer spending, and other areas. Having put out the situation in hand right now, having presented everything, we have to look at how these things can be prepared for in the future, how this kind of situation can be prevented so as so that all these clean tech companies won't be victims in this kind of disasters anymore. So first is diversification. Just like one of the companies said it did. Companies can diversify their financial relationships across multiple banks and other financial institutions. This reduces the risk of having all their eggs in one basket and can help ensure that they have access to the financial resources they need, even if one bank experiences problems. Second, resilient financials. Companies can work to maintain strong financial positions themselves. This might involve building up cash reserves or maintaining strong credit ratings, which can make it easier to access financing from a variety of sources. Lobbying. Companies can work with, all these clean tech companies now, can work with industry groups and policymakers to advocate for policies that support or promote financial stability and reduce the risk of financial crisis. For example, they might support regulations that promote transparency and accountability in the financial sector, or advocate for policies that encourage greater investment in sustainable energy and clean technologies. For instance, it was reported that the US government could have actually foreseen this kind of thing happening from the financials of from how transparent SVB was in their operations. They could have foreseen it and prevented the situation from happening, but due to their oversights, they couldn't see it in time in order to warn investors. So we see that all these clean tech companies have released forward-looking statements, and trust me, forward-looking statements are not always auspicious. The responses from the clean tech companies since the incident looks like they are immune to the effects of the crash, but they are not. This kind of statement is only as accurate as of the date it was written, and things might change in the future. Having said all that, I understand this is a major lesson for current and future startups in the energy sector. I hope they take hints from my suggestions on how to prevent this kind of situation, and I hope you listeners have picked a thing or two on my perspective to the situation. This is a green channel. Please like, subscribe, and turn on notifications for more. See you later. Thank you.